Okay, part 2. Okay. Hope I didn't lose my train of thought. Okay, basically, these guys, they have a lot of money. I mean, we don't have the hardware, we don't have the software, we don't have the capabilities, as in the backing of them. Like they have the fund size, billions of dollars. We don't have any of this. Their cost is so much cheaper than ours. Okay, which I'll explain cost later. It's called spread, right? Now, then how do we go up against these people? Okay, the only advantage a retail trader has is that we are small, and by small, I mean we are able to go in and out of the markets very fast, faster than all these people. We can buy and sell, no problem. Okay, for these guys, they have to be a bit more careful because they have billions of dollars, right? So when they pump in billions of dollars, they tend to move markets and they tend to lose the price. So that's the only advantage that we have. We can come in early, we can leave early, we can do a lot of things. Okay. This may seem like a small advantage, but this advantage can make us a lot of money. Trust me, right? And yeah, so I covered the participants, and let's see, next slide. Okay, these are the major currencies, right? The dollar constitutes about 61 or 60% of all Forex trades out there. Okay, Euro is about 30% or so. The rest are all the rest. So you have all this, the major currencies, right? These are the major currencies that most people are trading. Okay, of course you can trade exotic ones like Singapore dollar, the renminbi, and you know all this stuff. And even the ringgit, you can trade all this, right? But it's not a major currency, so it's best to stick with these currencies, right? Now, as I told you before, currencies are always paired up. Okay, there's always two. Okay, because if you are in the United States, if you were to come to Singapore, you have to sell your US dollars and buy Sing dollar, right? If you have any Sing dollar balance when you go back, you would sell your Sing dollar and buy something. So the money must be translated into something else, right? You can't be, you need to change the euro into something, right? So you need to change euro to dollar or yen or whatever, right? These are the major pairs, okay? There are 7 major pairs, and if, for example, you were saying you want to buy the dollar Swiss, okay? You were basically buying the dollar Swiss, the US dollar against the Swiss franc. Okay, next slide. Okay, there's supposed to be question and answers, but we don't. So let me just show you some stuff. Now, basically, when you are how it works is when you go to a money changer, for example, you would see the quote. It's in 4 digits. I mean, 4 decimal places. All currency pairs except the yen pairs. That means anything with dollar, yen, euro, yen, whatever. Any of the yen pairs are, I mean, other than the yen pairs, there are 4 digits, 4 decimal places. The yen pairs, there are 2 decimal places, right? 2 decimal places. Okay. So this is how it works. Now, how do we calculate stuff? How do we calculate profit? How do we calculate loss, risk, whatever? So this is the quote, the bid offer price, right? Now, the last 2 digits, or the last digit is the one that we're looking at. The last digit is called a pip, 1 pip, price index point. Let me just type it up, right? Just do a quick price. Points, right? Price index point, 1 pip, right? Now, look here. This, let's say it goes up. Let's say you buy at this price, it goes up 1 pip. It goes up by 1 pip. Okay. If now in stocks, a standard lot would be 1,000 shares. In the currency markets in Forex, one standard lot is $100,000. 100,000. Okay. So 1 pip equals to 10 US dollars on a $100 position. Okay, so every pip, every 100th of a cent equates to $10. Now, Forex is very flexible. The lot size, okay, can be moved, can be changed, right? You can have $10,000 instead of 100,000, and each pip will be $1. You can even go down to $1,000, and the lot size would be 10 cents, right? And it goes on. And most brokers allow odd numbers, odd sizes. That means like $1,001, for example. Okay, and then the pip value will change accordingly, right? Now, as I mentioned before, we're going to talk about spread, the cost of doing a trade, right? It's this. There are normally two prices. If you go to any money changer, there are two prices, right? A bid and an offer price, right? Now, a bid price is the selling price to you. That means now in the currency markets, you can buy and sell. Okay, you can buy and sell. That means if you think that this pair, okay, this instrument, okay, it's going to go up, you're going to buy, right? If this instrument you think it's going to go down, you will sell. You can buy and sell. You can bet both ways. You can bet that this instrument will go up, or you can bet that this instrument will go down. Okay. Now, the bid price is the selling price. That means if you want to sell, you look at this price, right? If you want to buy, you look at the offer price, which is this price. What's in between, it's called a spread, right? Let me just type it in. Okay, the difference between the bid offer is called the spread. So the spread here is 4 pips. Okay, which if you use a standard lot, it would be $40, right? That's the spread. The difference between a bid and offer is called a spread. Now, then, how do you which one do you look at? So if you're going to buy, let's say if you're going to buy the euro dollar, for example, you will buy at this price. But let's say when you buy, you say, okay, I want to sell it right now, right? You will look at this price. So if you buy at this price, you're going to sell at this price. Now immediately you will lose this. So if you're going to buy, let's say, okay, you think the euro dollar is going to go up, right? You want to make some money, right? So you say, okay, I want to buy euro dollar at 138.04, right? At this price, right? You can see. And let's say the price, now the spread would move with the price. So let's say the price moves 10 pips, right? So it goes up to 38.14, right? And this would become 10. Okay. Now that's how it moves. It moves together. The spread remains constant most of the time. Okay. It fluctuates if there's big news, interest rates, non-farm payroll, unemployment, and stuff like that. But we'll go through that later. Now, so you have bought at 138.04, and you decide, okay, now I've made money. The price now is a 138.14. I want to sell. So you look at this price. You would sell at this price. So 138.10. Okay. So what do? You sell, and you make 10 pips. Alright. Okay, my timer is done. It's almost 10 minutes. This is end of part 2. I'll come back at part 3 just a moment, okay? So stay tuned, and hope you have learned something so far.